We're going to explore the fascinating world of behavioral finance, which looks at how our emotions, biases, and mental shortcuts can lead us astray when it comes to making financial decisions. If you've ever wondered why seemingly rational people and markets often behave in puzzling ways, this episode is for you. So what's behavioral finance? Behavioral finance examines how psychological factors influence our financial decisions, in contrast to traditional finance theory, which assumes that people always act rationally. In the real world, we know that emotions and cognitive limitations can often push us to make decisions that aren't in our best interest. But why are we not always rational? Traditional models assume that we always seek to maximize our wealth in the most logical way possible. But in practice, our gut feeling, fears, and even physical or mental well-being can sway us to act irrationally. Whether we're buying stock, selling too soon, or refusing to admit mistakes, these tendencies can lead to systematic errors, sometimes on a massive scale. Now, there are major concepts in behavioral finance. One is mental accounting. We love to label or mentally earmark our money for specific purposes. You might have separate buckets in your mind for rent, dining out, or that future trip that you've been dreaming about. While helpful for organization, mental accounting can also cause us to treat money differently depending on its label. Another concept is the herd behavior. If someone around you is talking about something hot or rushing to sell in a downturn, it's tempting to follow the crowd. That's herd behavior, copying others, often out of fear or FOMO, fear of missing out. While it feels safer to do what everyone else does, it can drive dramatic market movements and amplify volatility. Another important concept is emotional gap. Emotional reactions like fear, anxiety, or even euphoria can cloud our financial judgment. If you've ever sold your investments the moment the market dipped, or gotten overly excited about a can't miss opportunity, you've experienced the emotional gap in action. Another one is anchoring. We often anchor our decisions to a reference point that might not be entirely logical. For instance, if you once bought a stock for $50, you might fixate on that price as the true value, even if market conditions have changed drastically. Anchoring can prevent you from adapting to new information. Next is self-attribution. Have you ever taken full credit for a winning investment but blamed external factors for losing one? That's self-attribution. It's the tendency to overestimate our own skills when things go well and minimize responsibility when they don't. Now, there are common behavior biases that we need to be aware about. The first is confirmation bias. We look for information that confirms our existing beliefs. If you're convinced a certain company is a great buy, you might only pay attention to news supporting that view, ignoring contradictory evidence. Another is recency or availability bias. We tend to overweight recent experiences, assuming they are more likely to repeat. If the market has been rising for months, we might believe it'll keep going up, even if historical data shows cycles of ups and downs. Next is loss aversion. People often feel more pain from a loss than pleasure from an equivalent gain. This can lead to an overly conservative approach, missing out on potential returns. It can manifest as a disposition effect, where we hold on to stocks too long, hoping they'll bounce back. Another one is familiarity bias. It's tempting to invest in what you know, such as local companies or the same brand you use daily. While familiarity can be comforting, it might result in lack of diversification and added risk. So let's look at behavioral finance versus traditional finance. In traditional finance, a concept called efficient market hypothesis, EMH, suggests that stock prices reflect all available information and that markets are rational. Behavioral finance, however, highlights that people don't always process information rationally, leading to mispricing, bubbles, and market crashes. And here's why it matters for you. Markets can go through emotional swings. Recognizing these swings gives you a better chance of making logical decisions instead of falling prey to panic or hype. Let's talk about practical applications. Understanding these biases isn't just academic. It can help you become a better investor or money manager. It helps you set clear rules, define your investment strategy or spending limits beforehand, reducing the influence of impulses. It helps you diversify. You avoid putting all your eggs in one familiar basket and you spread risk across various asset classes. And it helps you review regularly. You need to access your portfolio and spending habits to ensure that you're not succumbing to anchoring or recency bias. It helps you seek objective views. You can consult a financial advisor who can challenge your assumptions. Sometimes an external perspective helps counter your own confirmation bias. Total immunity from bias is impossible. After all, we're human, but you can limit their negative effect by actively questioning your reasons for each decision. Ask yourself, why am I really buying or selling this investment? Have I considered opposing viewpoints? Am I reacting to emotion or data? Is the decision aligned with my long-term goals? By staying aware of these pitfalls, you can edge closer to truly informed, rational financial choices. Behavioral finance reminds us that investing isn't just about numbers, it's about people. Emotions, biases, and mental shortcuts can drastically shape market outcomes and personal investing journeys. The good news is that once you're aware of these factors, you can take steps to rein them in, making more objective and beneficial decisions for your financial future. If you found today's video enlightening, I'd love for you to subscribe to the channel and share with a friend. Until next time, keep learning, stay curious, and remember, knowing your biases is the first step towards mastering them.